Welcome to Unlocking the Investment Upside with me, Jeff Robinson, founder of theinvestmentanalyst.com, and my co-host James, an ex-buy-side analyst. I try and explore the big ideas, and James keeps me on track. Today we're diving into Mosaic Theory, how elite investors piece together insights for an informational advantage. Investment research seems pretty straightforward, right? Find good companies, analyze their financials, make decisions. But what if the real edge comes from something that looks more like detective work than spreadsheet analysis?
You know, that's such an interesting way to look at it. Like piecing together this massive puzzle where the pieces are scattered across industries and markets.
Let me paint a picture of what I mean. Imagine you're studying a major tech company. Instead of just waiting for their earnings report, you're tracking their job postings, monitoring their suppliers' production schedules, and analyzing social media sentiment about their products. And
that's fascinating because it's all publicly available information, but the magic is in how you connect those dots, right?
Exactly, and this is where Mosaic Theory comes in. Think about how Tesla analysts might work. They're not just looking at car deliveries, they're tracking everything from lithium mining operations to battery factory permits to charging station installations across the country.
So it's really about building this comprehensive picture from seemingly unrelated pieces of information?
Precisely, and here's what makes it so powerful. While everyone else is focused on the obvious metrics, skilled analysts are picking up on subtle signals that others miss. Like when Apple was developing the first iPhone, some analysts noticed they were buying up unusual amounts of specialized glass and touch sensors.
That must create some interesting challenges though, especially when it comes to staying on the right side of regulations.
Oh, absolutely, and that's where things get really interesting. The SEC has actually given their blessing to this approach, but only when you're working with public information or non-material private information. It's like walking a tightrope between insight and insider trading.
How do analysts navigate that fine line in practice?
Well, let's break it down with a real example. Say you're researching Amazon. You can legally track their job postings, which jumped 1,200% in certain categories last year, monitor their warehouse expansion through public permits, and analyze shipping container data. But the moment someone gives you unpublished sales figures, that's crossing the line.
You know what's really interesting about this approach? It seems to reward a certain type of analytical mindset. Someone who can see patterns where others just see random data points.
Exactly right. And with the explosion of alternative data, this skill has become even more valuable. We're talking about analysts who can make sense of satellite imagery showing retail parking lot traffic, social media sentiment analysis, and even weather pattern impacts on consumer behavior.
Though I imagine there's also a risk of seeing patterns that aren't really there, right? Like finding shapes in clouds.
That's such a crucial point. The best analysts have developed what I call a healthy skepticism toolkit. They actively seek out contradictory evidence and maintain multiple competing hypotheses. For instance, fuller parking lots might suggest higher sales or just poor inventory management.
How has technology changed this whole process? I mean, we have so much more data available now than even 5 years ago.
It's created this fascinating paradox. We have access to incredible tools, machine learning algorithms that can analyze millions of social media posts, satellites that can track global shipping movements in real time. But here's the thing, having more data doesn't automatically mean better insights.
Sounds like information overload could actually make things harder rather than easier.
Exactly, it's like trying to drink from a fire hose. The real skill now isn't finding information, it's knowing which information matters. Some of the best insights still come from old school methods like talking to suppliers or watching how competitors react.
That makes me think about the human element in all of this. Even with all our technology, we still need that human judgment to make sense of it all.
And that's why I get frustrated when people say this kind of analysis is outdated. If anything, it's more relevant than ever. In a world where algorithms can process data in milliseconds, the ability to see the bigger picture and understand context becomes incredibly valuable.
So what would you say to someone who wants to start applying these principles to their own investment research?
Start by picking one company you're genuinely interested in and become a student of its ecosystem. Don't just look at their financial statements. Watch their suppliers, their customers, their competitors. Pay attention to the small details that others might miss.
That's really quite beautiful. when you think about it. This idea of piecing together a bigger picture from all these tiny fragments of information.
It really is, and you know what? In a world that's increasingly dominated by algorithmic trading and passive investing, this kind of thoughtful, nuanced analysis becomes even more valuable. Because at its core, it's about understanding the stories behind the numbers, and that's something that will always matter in investing.
Before we wrap up, I want to share something that blends my market passion with modern tech. I created Insight One to make Wall Street level insights accessible for all. It's where my decades of experience meet advanced edtech. Download Insight One on the App Store, Google Play, or visit theinvestmentanalyst.com. Start your journey today.